Well, thank you. It is a great honor to be the first guest speaker in today's celebration of the 40th anniversary of Prometeia. I too look forward to returning for the 50th anniversary. My previous visit to Bologna was, as Paolo Onofri was saying, was on the occasion of the 20th anniversary of Prometeia. And that was in 1995. The topic I was asked to address was the world over the next 25 years, in other words, looking forward to 2020, and in particular globalization with respect to trade, whether that trend would continue, and the relative growth of different regions. Now, I must say at that time I thought, making predictions 25 years in the future, this is easy. No one is ever going to check up on me. Well, here I am back at, I still have 5 years to go, but basically I have to live with the predictions that I made in 1995. And some of what I said then turned out to be right. For example, at the time, from the viewpoint of the United States, the big international economic problem was a challenge from Japan. I mean, it's sort of hard to remember that now, but that was what everyone was concerned about. And I made the forecast that Japan's trade surplus had more to do with a high national saving rate in Japan, and that as Japan aged, because it was aging more rapidly than anyone else, that the saving rate would fall and that the trade issue would diminish. Many economists were saying this at the time, but people outside of economics were kind of skeptical. It seemed so theoretical. But that prediction, I would say, turned out to be true. And then I tried to say where was a big growth potential over the next 25 years? What countries seemed to have pretty good fundamentals according to a growth equation, but hadn't yet completely realized them? And three of the countries that I named were Chile and China, and those two probably seemed like easy choices. The third was the Philippines, which was much less obvious at the time. Some of my other predictions turned out to be less accurate. I said in 1995 that 1999 was, as a starting date for the euro, was too optimistic, which obviously was wrong as a prediction of what actually happened, but perhaps catches a little bit of the skepticism that so many American economists had, some of which has subsequently been borne out. I'm not going to talk about Europe in my comments today. I'm leaving that to other speakers. There's two major questions that I addressed in 1995 that I am going to take a fresh look at this morning. One was globalization. Would it continue? Now, at the time, it seemed like a pretty obvious trend. Globalization, as measured by trade or any other measure, had been a dominant phenomenon of the previous 5 decades, the post-war period. In 1995, we had just had the formation of the WTO, the World Trade Organization, the successful completion of the Uruguay round. In the United States, we were completing NAFTA, and European Union seemed to be in full swing and highly successful. And it seemed somewhat inevitable that globalization would continue. But we're going to take a new look at that now. And then the other question that I tried to address 20 years ago, that I will try to update this morning, is which economies would perform the best? And one of those questions was, would China's economy surpass the United States? As of that date, China had just passed Germany and Japan to become the world's second largest economy, according to the World Bank, and that was, quite a surprise, something that people would not have expected before then. And if you extrapolated the growth rates, it suggested that by some measures, China would pass the United States by 2015 or 2020. So we're going to take a look at both of those questions, how they look in 2015. And in fact, contrary to simple extrapolation, global trade has slowed substantially since 2008, over the last 7 years. It's actually pretty remarkable. And so the question there is why? That's the first question I'm going to address. Secondly, China is slowing down, certainly over the last year, and perhaps because of the stock market bubble and crash, the crash of the summer, this has become a big topic of concern, whether how seriously China is slowing down. So we'll take a look at why that is. And then, like I said, I'm not going to talk about Europe. I'm not going to say much about the U.S., but other emerging markets, what is the prognosis for them? And I would say that right now they're at a delicate juncture. So I'm going to spend at least half my time on globalization, specifically with respect to trade, such as this cargo ship, which is being loaded in the picture. Certainly, as of 1995, globalization seemed like a really powerful, invulnerable long-term trend. Growth in trade was rapid during most of the post-war period, and trade was growing about twice as rapidly as GDP. The red line is trade, the blue line is GDP. In retrospect, this was more true of the 1980s than of the 1990s. This elasticity, this rule, that trade would grow twice as fast as GDP. But nevertheless, it held up throughout the post-war period. And you can see at the end there what's happened in the last 8 years. But let me hold off on that a minute ago. In this speech I gave and paper that I wrote 20 years ago, I did mention that there is nothing inevitable about the trend of economic integration across national borders. It's not inevitable, it's not irreversible. It's easy to think that it all has to do with declining costs of transport and communication due to technological progress and other innovation. And there's no question that that has continued. We've had the entire revolution of the internet. It's been possible now to trade all kinds of products, especially services, that it wasn't possible before. So that has continued. But the point is that that's not the only force that determines globalization. That there are other forces, political forces, that are important as well. And taking a broad historical perspective, we can recall that globalization was also very strong in the 19th century and up to 1914, and then there followed a 30-year period when the clock was turned back because of political forces. So I have in mind protectionism, tariffs, like the Smoot-Hawley tariff that we passed in the United States in 1930, and many other countries emulated similar measures at the same time. Discriminatory economic blocs. The world broke up into different blocs during the 30s, and then again with the Soviet bloc versus the Western bloc after World War II. And then, needless to say, World War I and World War II themselves put a near halt to trade. And as one would expect, as a result of those, trade fell. It contributed to the Great Depression, contributed probably to the World War. And so it could always happen again. There's nothing inevitable about it. That is a point I made before. And here's just a graph to illustrate that trade grew rapidly in the period before World War I, and also not so bad in the 20s, but it was in the 1930s that trade turned negative. Well, the big event here is the global financial crisis that hit in the fourth quarter of second half of 2008. And at the time, as it started to become clear that this was going to turn into a serious global recession, there was a lot of fear that countries might revert to protectionism as they had in the 1930s, and with similar results, that it would reduce trade and contribute to the magnitude of the recession. And this is one of the reasons why the G20 group was expanded into a leaders group that in some sense surpassed or rivaled the G7 group. And the leaders met December 2008 in Washington and April 2009 in London at the height of the recession. and agreed to not to take protectionist measures. But there were many who were skeptical of that, who said, look, it's easy for leaders to say this and then turn around, go back home, and put on protectionist measures to try to protect their own economies against imports. Well, we're 7 years past 2008, and the verdict is, for the most part, there has not been any big return to protectionism. Now, you might say that the period before that, in the 1990s, was a period of great liberalization. I already mentioned the WTO and the European Union and NAFTA and all that, and that we haven't had anything like that yet in this century. Perhaps now we will with the TPP and on the Pacific and similar negotiations with Europe. But you could say that the trend of trade liberalization has not continued, but there has not been a reversion to protectionist barriers, tariffs, and so on. I know there's some that disagree. Simon Evanet at St. Gallen disagrees, but pretty much everyone else comes to this verdict. But then here's the paradox. If there hasn't been a return to protectionism, why is it that the trade has indeed fallen? Certainly it stopped growing as rapidly as income, and of course income has been disappointing, growth has been disappointing. Relative to growth, trade has also been disappointing. Here we are 7 years afterwards, and global trade is virtually flat at the moment. Here's a graph. You can see the long-term trend, you can see the downturn in 2008, and then you can see that the new trend is far below the long-term trend. So I want to spend 10 minutes talking about why that might be. Initially, it was a bit of a shock that trade fell so much in the year 2009. Not just that it slowed below income, but it turned sharply negative, which hadn't happened since the 1930s. But a recession on that order of magnitude also hadn't happened since the 1930s, so we weren't quite sure what to make of it at the time. But here we are 7 years later, and trade still lags behind. And by the way, it's especially the emerging market economies, the developing countries and emerging markets, where the growth in trade had been so rapid in the 80s and 90s, and that has slowed down so much. Those are the bars on the right, represent developing countries and emerging markets. And that's where the growth in trade has actually been below the growth rate of GDP recently. Okay, why has trade slowed so much? Initially, when trade plunged in 2009, there were a number of hypotheses, a number of possible explanations that one heard. The first three I'm going to mention don't seem right now. One was protectionism, as I've mentioned. That hasn't really happened. Another was, if you recall, initially the price of oil was very high, and there was this idea in 2008 that the cost of transport was high, and maybe that's why there was less trade. Well, that one's obviously wrong, because the price of oil has come back down so far in the last few years, and yet trade has not revived. And the third one is that trade credit was essentially froze up along with the rest of the financial markets in 2008, and so that hurt trade. And that is true, but as with the price of oil, trade credit has come back, and I don't think credit availability is a constraint really today, and yet trade remains the same. I have, by the way, so many slides that I put some extra graphs into appendices, which are available if anyone is interested. And some of these points I'm making now are there, illustrated by graphs in the appendices. Well, let me leave aside those three explanations that turned out, I think, not to be right, and talk about the three explanations that do seem to me plausible still. The first one is that we had this tremendous process in the 80s and 90s of extending global supply chains, and that those have matured. I'm talking about the process whereby raw materials and components are sent to one Asian country, and then some value added is applied and sent to another Asian country, and then some assembly is made, and then it's sent somewhere else. And so you had a high volume of exports and imports, gross transactions, relative to value added, relative to GDP, and that has slowed down vertical specialization perhaps has largely run its course. And I'll elaborate on that in a minute. Second, physical investment in plant and equipment and machinery and construction has slowed. And I'll elaborate on that in a minute. And investment is much more trade intensive than consumption or government spending. And third, China plays a large role here. China's going to play a large role throughout my remarks this morning. And that China is undergoing what is called rebalancing, a shifting in the structure of its economy, away from manufacturing in particular towards services. And manufacturing tends to be trade intensive and services less so. So let me elaborate, if I could, on a little bit on each of these three explanations. First, on the global supply chains, you can see in the 80s and 90s that trade in components rose quite rapidly relative to overall GDP. This is the ratio of foreign value added to domestic value added is this in world gross exports is this particular measure. And it's really since 2005. This one began even before the global financial crisis. There was a sharp slowdown in that process. And to focus a little bit on the Pacific market, in China, the share of imports of parts and components relative to exports had risen in the 80s and 90s, and then sort of leveled off, and for the last 10 years has actually been declining. It's at a high level. There's a high level of trade in imports of components and parts relative to total exports, but that it's now coming back down again. And then this is for the U.S., and in the U.S. As well, the importance of parts and components as a share of U.S. imports peaked and has been coming back down over the last 10 years. That's explanation number one, is that this lengthening of the value-added chains has slowed down or even reversed. Explanation number two is to look at the components of demand. How much is consumption coming from households? How much is investment coming from firms? How much is government spending? And first, to look at the demand from all the advanced economies in the global recession in 2008, 2009, it's the investment component that fell very sharply. Consumption did not fall as much, which is a not uncommon pattern, but in this case it partly reflects the origins of the recession in the housing construction crash in the US and UK and some other countries. So the fact is that investment, plant and equipment and construction is more intensive in imports than consumption is. So if investment falls by more, then trade is going to fall by more. Now this is just what happened in the Great Recession, and we thought, well, that's a cyclical factor. That's very short term. That's not going to continue. But it actually has continued. These are the four different components of investment, plant and equipment, structures, and so on, and for the advanced economies. And in each of the four components, there is still, 7 years later, there's still a substantial shortfall relative to the preceding long-term trend. So that's one possible explanation. The second possible explanation for the slowdown in trade. And this has happened in virtually every region in Europe, the US, and elsewhere. The third of the three explanations for the slowdown in trade focuses specifically on China and to some extent the rest of Asia, which really matters in the world economy. This is where a lot of the increase in trade took place in the 80s and 90s, at least not just within Asia, but between Asia and other countries. Well, we have this rebalancing phenomenon going on in the Chinese economy, which I think is, normal and to be expected and desirable. China, for a long time, had tremendous success through manufacturing as opposed to agriculture or services, and by selling to exports and to investment demand rather than consumer demand. But I think that it's used that up. I make the analogy of a man who's like very developed on the one shoulder, one arm, and underdeveloped on the other. And Chinese economists and Chinese officials have talked about and I think made the decision to try to develop the other half of the economy, switch from manufacturing to services, and to switch from investment-led and export-led growth to growth led by consumer demand. The leaders decided to do that formally at the third plenum in 2013, and to a substantial extent, they have been doing it. The economy has been switching, whether through government action or naturally, I'm not sure. But switching to services, which are less intensive in trade than manufacturing is. So here's a few graphs on that. This shows exports and imports as a share of GDP. And it's China where in the 80s and 90s and up to in the early part of this century, where trade was growing much faster than GDP, as the red arrow shows. In the United States, trade was growing somewhat faster than GDP, but not that much faster. And in the European Union, it was pretty much flat. In other words, trade was growing, but only in proportion to GDP. So the fact that we've had this subsequent slowdown in trade in China relative to GDP is substantial. Here's Japan shifting into services. It's hard to measure, but judging by the available data, this is the official data on the tertiary sector, and it has been increasing over the last 10 years. It's, in the case of China, the GDP statistics or any statistics, it's good to have checks to look at other possible measures. And so here's one that might not be so obvious, but is in a sense reliable and suggestive. And this is from Nick Lardy at the Peterson Institute. Railway traffic. What has happened is that in China, the share of traffic which is freight has come down a lot over the last 5 years. And the other graph was passenger traffic. So more passenger traffic, less freight traffic. So that's really consistent with a shift away from manufacturing. Here's a measure of industrial production in crude steel, cement, raw coal, the activities that are intensively used for manufacturing and for physical investment. And where China not long ago was just gobbling it up at a historical record rates. And that is coming down now substantially. So that has a lot to do with exports of commodities from emerging markets and Australia and so on, Latin America. So I think this is one of the reasons, the slowdown in service, the move towards services is one of the reasons why trade's relative importance in China has peaked. China still trades a lot, but as a share of GDP, it's actually been coming down since the global recession. All right, well, that's my first big topic. Why has trade slowed down? And, will this continue? I think the investment component hopefully is sort of temporary. Hopefully investment will recover unless the secular stagnation hypothesis is really true for the long term. The other two explanations probably are permanent. I think in retrospect, the post-war period, especially the 90s, was not the norm. That it's normal for trade to grow, and trade will continue to grow, but the phenomenon of trade growing twice as fast as GDP, which seemed almost like a law of nature 20 years ago, I think we were probably wrong about that. And I think trade will not grow twice as fast as GDP in the future. Topic number 2 is on this theme of performance, economic performance by different countries and who's up and who's down and all that. I want to talk about the size of the Chinese economy. And I'm breaking this up into 2 different questions. One is, did China catch up with the United States last year in 2014 to become the largest economy in the world? If you like these rankings, then this is an important question. And then a second question is China's recent slowdown, because since then, this year, all the news is about how much China has slowed down. So both phenomena are important. One is a cumulative measure of China's long-term success, and the second is where are we now, and where is China going from here? So I'm going to spend 10 minutes on this first question of the size of the Chinese economy, and then turn to the slowdown. Well, let's take a really long-term perspective for a moment. This is a graph of relative GDPs of major regions over the last 5 centuries. And if you go back 2 centuries, you see China, a red peak back there. China was actually the largest economy in the world 2 centuries ago. These are GDPs measured on a PPP basis, purchasing power parity, which is going to turn out to be important. But these are the numbers we have for the moment from Angus Deaton. Of course, China fell behind for most of those 2 centuries, as it did not participate initially in the Industrial Revolution. And then the story for the last 30 years has been China catching up. That's the red arrow. And conversely, Europe and the US have been coming down as a share of global GDP. So that, roughly speaking, we're all crossing as shares of global GDP. Speaking on an historical basis, so China is back again. Is China already there? This time last year, there were these breathless headlines, I don't know about it here in Europe, but in US newspapers, that China had now surpassed the US to become the world's largest economy. And these headlines were based on numbers from the World Bank using the International Comparison Project, so they're PPP numbers. And it was the latest 6-year update of these numbers, and then extrapolated for another few years to get to late 2014. And according to those calculations, yes, China is the world's largest economy. Well, let's review a few of the facts. There's no questioning how historic and impressive and genuine the Chinese economic miracle is. Roughly speaking, China grew for almost 10% per annum for 3 decades. But for historical perspective, when Great Britain first went in the Industrial Revolution, it took 58 years to double its income, starting from 1780, and similar with other European countries. For the US, it took 47 years for us to double our income, starting from 1839. For Japan, it took 35 years, starting from 1885. For Korea, it took 11 years, starting from 1966. But then for China, it took about 8 years, starting from 1987. So this is a trend here, that it's happening faster and faster. And maybe once you have the right conditions right, it's easier to catch up because other people have done the technological discoveries before you and the innovations. And so it's a question of emulating them and investing to bring it about. On the other hand, and a lot of people forget this, I think a lot of Americans in particular forget it, China is still a poor country if you look at income per capita. It still ranks only midway among 190 countries, 85th, right in the middle, just above Peru. It's past Albania, it's just now about at the level of Peru, or it's past Peru, which puts things into a different kind of perspective. So, of course, the claim that the U.S. economy is now the size and the Chinese economy are now the same size comes from multiplying a middle level, at best a middle level of income per capita, times 1.3 billion people. That's a lot of capita. That's the largest population in the world. So here's undeniably the impressive growth record of China over 35 years. This is a graph from The Economist, which I think is quite useful. It shows the countries arrayed. The height is income per capita. So this is even by the PPP measure, and you see that China is still only in the middle, and the U.S. close to the top in income per capita. U.S. and Europe is much richer than China still, but the width of the rectangle represents population. And of course, total GDP is equal to income per capita times population. So it's the area of the rectangle that matters. And by this measure, China has just now caught up with the United States or passed the United States. And if you're curious, Italy is right there. Income per capita is in between, obviously a smaller population, so it's a narrower rectangle, the blue rectangle. So it's this PPP measure, purchasing power parity measure, that is the basis for these claims that China passed the United States in 2014. But to my mind, that's a misapplication of the PPP numbers. I think it's very useful to do this calculation. So the issue, for those of you who might not be familiar, we measure China's GDP in renminbi, the Chinese currency, and US GDP in dollars. How do you compare them? The most obvious thing to do is just use the current exchange rate. Well, if you do that, you get a very different answer. I'll show you in a minute. The PPP calculation looks at purchasing power in China. How much does a renminbi or yuan buy in China, including housing and haircuts and all kinds of services and goods that are not internationally traded? Which is a very important question if you want to measure the standard of living or income per capita. It's not so clear that that's the right measure if you want to compare the size of the economy. So which measure you choose should depend on what you're looking at, what question you want to answer. That's true in economics generally. I'm listing here some examples of questions that we might be interested in. The questions in the left column are going to have to do with income per capita, and the questions in the right column are going to have to do with the size of the total economy. And I would say, as a rough rule of thumb, if you're interested in income per capita, you probably want to look at the PPP measure. But if you're interested in the size of the whole economy, you probably want to look at the simpler measure of using current exchange rates to compare. So, for example, if you're trying to judge whether governments have successfully raised the living standards, income per capita is the right measure, and so there's no denying the Chinese accomplishment. If you're trying to ask a question, okay, we've done enough now to achieve market-measured income, but what about the fact that we can't breathe the air and the environment, and are we now rich enough to be able to afford to do something about that? The answer is yes, in the case of China, and to start doing something about that. And again, you'd want to use income per capita as the measure. If the question is, what's the normal value for the currency? There's been a lot of concern, especially in the United States over the last 10 years, that the renminbi was undervalued. Well, then you would want to look at income per capita, the so-called Balassa-Samuelson effect. But let's look at some questions now, all of which have to do with the size of the total economy. If you're a multinational corporation and you're trying to judge where the big markets are and the growing markets, you're interested in the size of the total economy, and you're interested in what they can buy at world prices, not what does it cost for a haircut or an apartment within China. So for that measure, I would think you'd want to use the current exchange rate to compare GDP. Political scientists, people who specialize in international relations, are interested in things like, well, not just them, but is the country big enough that it should have a bigger quota in the IMF? Well, China should, of course, but for that you'd want to measure total GDP. They look big enough on that measure that their quota should be much larger. The international relations people are concerned about projection of military force. How many ships can China's Navy buy? Well, ships are basically internationally traded goods, and so you'd want to use current exchange rates to measure that. How big is the global role for its currency? For example, this question that the IMF is now just in the process of including the renminbi in the SDR. For that, the proper measure, again, is actual exchange rates. Well, if we use actual exchange rates, the graph from The Economist looks a little bit different. There's the US, high income per capita. There's China. Its population is the same, of course, however you measure it, but the height of the rectangle is much much lower. And the size of the rectangle now is different. By this measure, by the current exchange rate measure, the United States is still bigger than the Chinese economy by 2/3 or 70 or 80% in fact. So the one on the left is the US dollar terms, where there's still a substantial difference. It's only the one on the right, which is the PPP terms, that China has now passed the US. Here's my graph. The small lines are what was reported in the newspaper, that on PPP basis, China has passed the US. The dotted lines are a projection. And a projection is it'll probably happen in the 20s, the 2020s. If you extrapolate recent rates of growth and real appreciation of the currency, then it might happen as soon as 2021. But more likely, those things are slowing down, and more likely we're talking about 2028 or 2029 when China does finally pass the US economy. All right, next topic. What has received so much attention this year, China's slowdown. And it's really quite impressive how quickly press reports turned from emphasizing that China had passed the US to be the world's largest economy last year to despairing that the Chinese economy was, or maybe celebrating, I don't know. But anyway, remarking that the Chinese economy was going downhill. No question that the Chinese economy has slowed down substantially. One big question is the slowdown permanent? I would say if we're talking about the fact that China until recently was growing at rates greater than 10% and is now growing at 7% on official figures and probably somewhat less, yes, I think that slowdown is permanent. I think we've probably seen the end of 10% growth rates as a year in, year out steady kind of thing. That part is probably permanent. But I want to ask about some of the reasons. Why might that be? And then the next question is, will it be worse than that? Are we talking about a slowdown only to 6 or 7%, or could it be more than that? Which includes the question, will it be a hard landing or a soft landing? Well, here's the official figures on Chinese growth. Obviously, it fell sharply in the global recession, and then came back very quickly, and is now declining again. Please note the scale. It may look like growth was very low in 2008 and now, but that bottom of the scale is still 6%. And 6 or 7%, which is slow for China, is a growth rate that all the rest of us would be very happy to have. But still, a slowdown is a slowdown. And particularly because China is so large in the world economy now, it matters for all of us. Now, first, the official 7% may understate the magnitude of the slowdown. There have been plenty of reports saying, let's look at other measures like electricity usage or freight car loadings and all that, and they suggest that the slowdown might be much more than 7%. I think there's probably some truth to that. It is certainly suspicious that the Chinese government said ahead of time, this year we're going to grow at 7%, and then what do you know, the growth came in at just almost exactly 7% each quarter, and if it's 0.1% above or below, that's noted or remarked upon. Probably those statistics are not to be trusted entirely. On the other hand, looking at energy usage or these other measures isn't really the right thing to do, because we're pretty sure that China is rebalancing away from manufacturing towards services. So the fact that energy usage has slowed down somewhat, thank God, or that freight car loadings are slowing down, that's consistent with either hypothesis. That's consistent with the hypothesis that the whole economy is slowing down more than 7%, but it's also consistent with the hypothesis that in addition to the whole economy slowing down 7%, there's this reallocation away from manufacturing towards services. All right, either way, we have a long-term slowdown. What are some of the reasons? There's a lot of possible reasons, and my guess is that each of them has some truth. The first set of reasons is that it's part of natural convergence. If a country starts off far behind and the right conditions are in place, it can catch up relatively rapidly. It can emulate the frontier technologies. It can to some extent, copy, start producing goods that have previously been produced elsewhere. Just relocate the factories from Japan to Korea and then from Korea to China to take advantage of the cheap labor. And that's sort of easier to do than it is to innovate the factory in the first place. Well, that includes catching up with the frontier countries in technological terms. It includes coming from a very low capital labor ratio, which China had 30 years ago, but having very high rates of investment, and so raising the capital labor ratio rapidly, which China has done, following Korea and Japan, which did the same thing before them. But obviously you run into diminishing returns eventually, if the capital labor ratio gets very high. Third is particularly important in China's development has been rural-urban migration. There was a lot of surplus labor in the rural sector. It was migrated, a huge phenomenon, to the coastal provinces, to the cities in particular. But that's probably run its course. I mean, it's not completely finished, but the cities are now quite crowded, and the wages have been bid up in the cities and the coastal provinces, and the price of land has been bid up, and so there's no longer these great gains to be had from rural-urban migration. I just mentioned the rising cost of labor and land. Labor in China is no longer cheaper than in Mexico. It was for a long time much cheaper, but it's now past it, and same with land. We've already talked about services in the context of that they're less trade intensive, but they also tend to have lower productivity growth. That's true everywhere. It's harder to achieve productivity growth in haircuts or construction or medicine or teaching or all kinds of services than it is in agriculture or manufacturing. Then there's a famous middle income trap. It's just a problem that all countries have to deal with when they reach middle income. I'll show you a slide about that. And there's a very interesting paper that was presented last year by Lant Pritchett and Larry Summers that I'll tell you about on regression to the mean. And then there's aging, which all of us are doing, certainly as individuals, but also as countries. And this is taking place in China, and we're particularly focused on this now with the end of the one-child policy, which I think did a lot of damage, and as a result of which, the one-child policy, that is leading to rapid aging in China. Well, this is the middle income growth trap. So each dot represents a country, as it was 50 years ago, and as it has been most recently. And there's, of course, in general, a positive relationship, but there is this notion that once you've reached middle income, it may be harder to continue to grow after that. Now, it's true that countries that are in the middle income face a certain set of questions, such as shifting from manufacturing to services, for example, and so on, how to continue the growth. But there's some drawbacks of this viewpoint. I mean, well, first, statistically, the statement is that there's a slowdown of about 2.5% in the growth rate after the middle income on average. One question is how you define middle income. If you ask countries, you get similar answers to if you ask people. At least in America, if you ask people, are you lower class, middle class, or upper class? Everybody says they're middle class. No one wants to think of themselves as in the lower class or the upper class. And to some extent, that's true of countries, that China was not a middle-income country 20 years ago, and it's not even that clear that they are now, depending on how you draw it. But the critique that I'm particularly intrigued by comes from this paper by Pritchett and Summers, which is called Asiaphoria Meets Regression to the Mean. So regression to the mean is a phenomenon that if one person is tall, especially tall or especially short, their children will most likely be somewhat tall or somewhat short compared to the average of that country in that point in time. But there's a bit of regression to the mean, back towards the average. And that's true of countries as well. If you've been growing very rapidly, if you've been growing more than 10% in one period, the chances are you're going to slow down in the next period, and vice versa. And what Pritchett and Summers find is when you take account of this phenomenon, that dominates. There's no statistical tendency for a middle income trap. just the fact that you've achieved middle income doesn't mean that you're going to grow more slowly thereafter. The fact that if you've gotten there by growing rapidly over the preceding 10 years, then you're more likely to slow down, but that's a bit of a different phenomenon. Anyway, the bottom line is, based on purely, nothing specific about China, but for any country, just based on the regression to the mean, they say that China's growth is expected to slow down, not just to 7%, but to, let's say, 4%. And that paper already is looking a little bit prophetic. On that list about convergence and middle income trap and regression to the mean, my last item was aging. So the three bars on the right are for China, the others are for other countries, and this is demographic factors. What percentage of the population is in the labor force and is actually working. And that's actually coming down quite rapidly in China, and so that's probably a contribution to slower economic growth as well. So yes, transition to slower path. Will it be a hard landing or a soft landing? I don't know. There are reasons to worry and to think that maybe it'll be like Japan, which I call a hard landing. One is that investment has been so high up until now, investment in heavy industry, and that's unsustainable. And they're already trying to shift out of high investment, but I'm not sure how much they're succeeding. Second is a high debt. China's got a lot of debt, and leverage can work well when you're growing rapidly, but it leaves you vulnerable if you slow down. From the viewpoint of individual corporations or households or the country as a whole, high leverage is something that is only compatible with a period of rapid growth. If you transition to slower growth, you may really crash if you have high debt. And in the case of China, there's a lot of bad loans by the shadow banking system, but both the banks and the shadow banking system. The government having directed banks where to lend. And recently there have been a lot of dollar-denominated loans, which in China, as among many other emerging markets, would lead them vulnerable. So I think they've identified the right reforms, reform of rural land rights, the hukou system, making the economy more market-oriented, addressing the environment, but they do need to carry them out. All right, if I have time, am I doing okay? 5 minutes, I can do that. Emerging markets more generally. And to sharpen the question, we're at a particular point where the US economy this year has done quite well. I mean, actually 3% growth in the last half year, and in a sustainable basis, growth led by private sector consumption and investment. In that respect, a little reminiscent of the 1990s. And we're pretty much at full employment. We're all expecting that the Fed is probably going to raise interest rates for the first time in 7 years. We've had 7 years of interest rates close to zero in its meeting December 15th. And there's a divergence. The rest of the world, Europe, Japan, emerging market countries, they're all slowing down. They're all in the process of easing monetary policy, or have been up until now. So the question arises, when the US raises interest rates, is that going to impact emerging market countries? How much, and which ones? I think some emerging market countries are vulnerable to increase in US interest rates, and the history is clear. I think the Volcker monetary tightening of the early 80s helped precipitate the international debt crisis. It wasn't the deep fundamental cause, but it helped precipitate the international debt crisis. I think the Greenspan tightening of 1994 helped precipitate the Mexican peso crisis. So there is a history, and it's right to worry that emerging markets might be vulnerable. Now, they've had plenty of advance warning. We've all been talking about this for 2, 3, 4 years, and I think many of them actually are prepared, are in shape. But some of them are vulnerable. Which ones? So the last thing I want to talk about is the fact that after the turn of the century, many emerging market countries learned some important lessons from the crashes of the 1990s and adopted stronger policies. The 5 most important areas, there's plenty of microeconomic reforms that were undertaken, but I'm emphasizing macroeconomics here. And the 5 most important were more flexible exchange rates, higher holdings of foreign exchange reserves, smaller current account deficits, less dollar-denominated debt, which is particularly vulnerable, and instead more reliance on foreign direct investment, on equity, or borrowing in your own currency, and less pro-cyclical fiscal policy. I'm going to elaborate on those last two, the currency of denomination and the cyclicality of fiscal policy. But all five of them were substantial improvements in many emerging market countries, and I think the global financial crisis in 2008 showed the value of this, because the emerging market countries came through the crisis surprisingly well, much better than the US or Europe did. And I think that these reforms were part of the reason. But among many of them, there has been substantial backsliding since 2009, especially on fiscal policy and debt. So let me elaborate on the two, on the cyclicality of fiscal policy. Fiscal policy has traditionally been pro-cyclical in developing countries, meaning that when the country is booming, especially commodity producers, they think, oh, everything's great, and they increase spending, and they exaggerate the height of the boom. And then when there's a downturn, particularly for commodity producers, or if world commodity prices go back down, then they're forced to cut back. So they exacerbate the swings. This is destabilizing the booms and the recessions. This is a traditional pattern in the 60s, 70s, 80s, and 90s. Well, after 2000, a number of them managed to switch, to beat this pattern. To achieve counter-cyclical fiscal policy. To take some of the best examples, in Africa is Botswana, in South America is Chile, and in Asia was China, to some extent India, Korea, Malaysia, some of the others, managed to stop following pro-cyclical policies and switch to counter-cyclical policies. So these bar charts, you probably can't read the individual countries, but each bar is a country. The yellow countries are developing countries. The black countries are advanced countries. What we're measuring here is the correlation between the business cycle and government spending. And this graph is for 1960 through 1999. The positive bars are pro-cyclical, destabilizing, which is most developing countries, and the negative bars are counter-cyclical. That's what you want, that you, in a boom, you strengthen the budget, and then in a downturn, you've got the fiscal space to relax fiscal policy. And to a first approximation, the developing countries were all pro-cyclical or destabilizing. Here's the number one is Azerbaijan, typical oil producer. When the economy was booming, we're rich, spend all the money. When the price of oil goes back down, and of course a lot of the oil producers are contending with this again today, they're forced into a deep recession. So there's Azerbaijan at one extreme. At the other extreme, the most one is extreme is Switzerland, but even Greece was following counter-cyclical policies during this period. And typical developing countries were pro-cyclical, and there's Chile as an example in the middle of the pro-cyclical countries. That's until 1999. But as I said, many of them learned from the mistakes, and after the turn of the century, some of them switched. And many of those many of the yellow bars now appear on the left-hand side. About a third or more of the developing countries, 19 of the major developing countries, switched after the turn of the century from pro-cyclical or destabilizing fiscal policy to counter-cyclical or stabilizing fiscal policy. There, for example, is Chile with a very counter-cyclical fiscal policy, which is just what you want. They saved a lot during the boom when the price of copper was going up from 2001 to 2008, paid down their debt, saved a lot, and that put them in a really good position in the global financial crisis and when they had their earthquake to increase spending. Meanwhile, you have some countries like Greece. Remember, Greece used to be all the way over on the left. Now they're all the way over on the right. Pro-cyclical, destabilizing fiscal policy. Most recently, we've had some backsliding among some of the developing countries over the last 5 years. So Thailand would be an example of a country that achieved counter-cyclical fiscal policy in the first decade of this century, but more lately is back there again on the pro-cyclical side. That's Thailand on the right. Brazil never quite achieved counter-cyclical policy, but it was about neutral. It was about zero. Well, in the last 5 years, they've been on the pro-cyclical side. And countries like Argentina and Venezuela never did achieve counter-cyclical policy. They've been pro-cyclical all the way throughout, and they're paying the price for it now. And here's Greece, which is now all the way over there on the right, the most pro-cyclical country. Not completely at their own choice, of course. They can't entirely dictate their own fiscal policy. So that was a fiscal policy. My last graphs have to do with currency composition. That in the 1990s and the 1980s, many developing countries borrowed in terms of dollars, or if it was Asia, maybe in terms of yen, or in Eastern Europe in terms of euros, but borrowed in terms of foreign currency, which left them in a terrible situation when there was a downturn, because they couldn't devalue, or if they did devalue, the currency mismatch meant that they had severe adverse balance sheet effects. But after the turn of the century, many of the developing countries, here's 14 of them, managed to start borrowing in their own currencies. And I think this is a tremendously useful trend, and was part of the reason why so many of them did okay, did fine in the global financial crisis of 2008, 2009. Since then, most of the governments have continued pretty good pattern of currency composition, borrowing more in their own currency, but the corporate sector, the private sector, has been borrowing in dollars like crazy, and this is a major vulnerability among many emerging market countries. All right, so to conclude, we all think that the Fed is going to raise interest rates. I think so, probably in 2 weeks. There is a question, well, the ECB and the Bank of Japan and the other major central banks are easing just as fast, so globally, overall, won't that cancel out the tightening of monetary policy in the case of the US, so that we don't have to fear, the emerging market countries don't have to, in particular, don't have to fear a world recession. And I think there's some truth to that, but those emerging markets that borrowed in dollars are in for trouble, because as the US tightens and the ECB loosens, the dollar goes up, euro goes down, and for those countries that borrowed in dollars, especially the commodity producers, they're the ones that I think are going to be in the most trouble. But I have to say, the central bankers I've talked to from emerging market countries say, enough already, just get on with it, raise interest rates. We will find out pretty soon. Thank you.
Thank you, Professor Frenkel. Now, ora è possibile fare una o due, diciamo due domande al Professor Frenkel, se c'è qualcuno che sono due domande. Lì. Tre, ce n'è un'altra.
First of all, let me thank you for your very comprehensive and thought-provoking speech. I guess that most of many other questions which come to my mind, there is one which has been there for a long time by now, and it has to do with political international relations, which I believe are shaping international trade, even though we're not accounting for them in economics, and I put myself between everyone else. And more than what has happened in the past 10 days, but which has been there for a long time now, so more than terrorism, what I'm thinking of is a disintegration of traditional political relations which were there before, well, until the Cold War was there, and then incredibly changed over time. So what we have now are coalitions which are very liquid and change from time to time, but with some recurrent, at least in my view, agreements. Think of the Sino-Russian economic interests. And these agreements, which have two big components, one are commodities, and the other one are international trade treaties, tend to shape international trade in overall flows. So in your view, how much do international relations weigh on the future of international trade? First question. And second question, are international treaties such as the TPA or the TTIP at least a partial answer to the continuing changing political alliances over the world arena? Thank you very much.
Let's take the other two questions that were asked for around there. The micro there, il microfono là. And
thank you very much. Thank you for your presentation. Just linked to Alessandra asked you now, I observed, I observed that after the signature of the Uruguay round agreements, world trade between 1995 and 2007 grew by above 8% per annum, 2 percentage points higher than the previous period. I'm not saying there's any causality, just observing it. So do you think that the Trans-Pacific Partnership and the Transatlantic Trade and Investment Partnership can give an impulse to world trade growth, if any? And the second question, if I can, regards, I would say the fragility of some selected emerging countries. You just show that it's not only a matter of dimension of the external debt, but also of issuers, and the private corporate sector seems to be exposed on the international market in many of these countries. And I would say, as you already said, it's not only a matter of external debt, but total debt. So do you think, and someone says this is a sort of third step of the Great Recession, the first one being the private debt in US and UK at the beginning of the Great Recession, the second one being the public sector, huge debt, especially in the Euro area countries. So do you think that as long as we are seeing that the private sector in US, the private sector debt in US is stabilizing, the debt in the emerging country can be, let's say, another break or a big risk for this already fragile recovery of the world economy? And should we expect for several years world trade growth along that flat trend that you showed before, the flat trend between 2009 and 2014? Thank you.
thank you. Last question around there.
Thank you. No, I was just wondering if you could say something about Europe. Hello, I'm here. Sorry. I was just wondering if you could say something about Europe and in, specifically the speed and size of the recovery you might think about. Thank you very much.
Yes, which is a theme that we are going to deal with in a few seconds. So while you are answering, Alberto Giovannini, Carlo Bastasin, and Romano Prodi can have the seat there. Okay.
With this panel coming up, I don't feel I can or should say too much about Europe, but let me try to answer each of these questions as quickly as I can. First on international relations, I think in retrospect, a huge part of the reason why trade grew so rapidly in the 1990s is the huge historical development we had, which was the end of the Cold War, and the Soviet bloc, Central Eastern European countries, and Russia, and of course China separately, having started earlier, but joining the world economic system. I think in retrospect that was a big part of the reason why trade grew so rapidly, and so that was a transition phenomenon that was not going to continue indefinitely. So I think that's right. Both the first questioner and the second questioner were asking about the trade agreements we had in the 1990s, the Uruguay round and NAFTA and all that, and I think that I think they did help. I mean, these trade agreements never have quite as much effect as either the proponents claim or the opponents claim, where it's going to be revolutionary, but they have important effects. At the moment, we've just completed the negotiation of the TPP in the U.S. and among Pacific countries, and it has to be ratified. And next up is the TTIP with Europe. There's tremendous opposition in the U.S. Congress, and we'll have to see what happens. Mostly coming from the left wing. I mean, some from the right wing. It's all rather confused. I have written a few opinion pieces in newspapers, Project Syndicate and some local newspapers, supporting TPP because I think it's a good agreement. And I've just been, you get a lot of attacks. I mean, this is just the way life is in the blog world or the op-ed world. But there's a lot of people, particularly on the left, who just, I think they haven't read it. I think they haven't looked at it. I think it will be good for growth. I think it does have a lot of traditional trade liberalization in it because there are still the major tariffs in many countries, and it does help to bring them down. But the most interesting area is the areas that go beyond traditional tariffs and quotas and look at deeper integration. People on the left are particularly concerned about the environment and about labor rights. And I think there's all kinds of good things in TPP. I don't yet know about TTIP, but there are all kinds of good things in TPP to help labor and the environment, and that's one of the reasons why I support it. The opponents say, oh, well, we don't know if it'll really be enforced. Well, I mean, what do you have to lose? There's much more likelihood it'll be enforced there. For example, trade in endangered species. We have CITES. We have a treaty of trade in endangered species. It's not being enforced. This is an attempt to enforce it, just what the environmental NGOs asked for. And so I can't imagine why you would want to oppose it based on that. So both on economic grounds and on other grounds, I think these are encouraging. And we have had a hiatus of 10 years. The Doha round has gone nowhere. Most of us economists would prefer multilateral trade liberalization through the WTO, something like the Uruguay round. But if we can't get that, we'll take the other one. Very briefly on emerging markets, it's at the third round after private bank debt crash and public debt crash. Maybe. I think probably it's becoming less and less useful to talk about developing countries or emerging markets as a class. What we have seen over the last 10 years, whereas it used to be no overlap, if you look at the credit ratings from the rating agencies, or you look at sovereign spreads, or you look at the size of debt, by all these measures, you had the advanced countries up here and the emerging market countries here. What we've seen over the last 10 years is an intershuffling. So many of the emerging market countries now are doing better than some of the advanced countries. And so I think it's differentiation, case by case, country by country. Just on Europe, one or two sentences. My answer for Europe is the same as the answer for everybody, which is that the debate has been too much phrased as fiscal austerity versus fiscal stimulus, as if one or the other is always the right answer. The right answer is to try to be counter-cyclical. During a boom is the time for fiscal discipline. During a recession is the time for fiscal stimulus. And many politicians in both the United States and Europe almost have it backwards. That when there's a boom, they say, oh, we can afford, your deficits don't matter anymore. I'm thinking of Vice President Dick Cheney, for example. During the boom, he says deficits don't matter anymore, and they run up big deficits. And then when there's a recession, all of a sudden, some of these politicians think, oh, we got to cut the deficit really urgently right away. That gives you pro-cyclical, destabilizing fiscal policy. Countries like Chile have learned how not to do that. It seems like that we should remember.